Hello and welcome to Ticker Tapes. It's Monday, so that means we are getting stuck into the world of FAANGs once again. Now, the fighting in Ukraine continues to dominate the financial markets, and even the much anticipated March meeting of the U.S. Federal Reserve's Open Markets Committee, or FOMC, may not be enough to switch the narrative. A rise in interest rates could actually reinforce the idea that the economy is moving towards a period of stagnation. That is one where we have higher interest rates, high inflation, low growth, and lower investment returns, and in particular, lower real or inflation-adjusted returns. Stagflation has really only appeared in the economy during the 1970s following sharp rises in the price of oil. That's not a good omen when WTI and Brent crude oil are up by around 65% year over year. The technology sector, including the mega-cap FAANG stocks, is not expected to do well in these conditions. Swiss bank UBS finds that recent moves in U.S. equity sectors are fairly consistent with their prior performance in periods of low growth and high inflation. That could mean the days of supercharged price performance among FAANG stocks are over, or at least on hold until the crisis in Europe and the disruption of supply chains are resolved. That may be the long-term picture, but there were still reasons for investors to cheer in the short term as Amazon announced a $10 billion share buyback and a 20-for-1 stock split, which should take effect in early June. Amazon stock jumped by 5.41% on the news, which Morgan Stanley called an important positive signal for the shares. Stock splits make no material difference to the finances of a company, but they are popular with investors because they make a high-priced stock more affordable and can help to broaden share ownership as a result. Existing shareholders will see their current holdings subdivided by 20 when the split takes place, with the stock price divided by the same amount. Meta Platforms and Alphabet are being investigated by the European Commission, which has launched an antitrust inquiry into their online advertising activities. The Commission believes that they may have broken European competition laws over the way that advertisers compete for display slots on websites and other mediums. The EU will liaise with the UK's Competition and Markets Authority, the CMA, which has an ongoing investigation into the same issues. Apple's manufacturing operations have been in the headlines again this week after it emerged that the iPhone's makers' orders accounted for 26% of 2021 revenues at Taiwan Semiconductor, one of the world's largest silicon chip manufacturers. Apple's share of TSMC's revenues rose 20% year over year, underlining the importance of the world's largest company at a time when spare capacity in chip manufacturing is virtually non-existent. Netflix is planning to raise prices for subscribers in the UK and Ireland, following on from price rises for US and Canadian customers announced in January. Netflix is reported to have justified the price hike by saying it was warranted given their investment in programming, talent, and creative industries. The price hike comes just as investment bankers Evercore turned bullish on Apple TV Plus following its recent acquisition of the rights to Major League Baseball, saying that Apple's goal is not to become Netflix, but instead it's to focus on high-quality scripted content and desirable sports rights, and that in this context, that Apple is making a lot of good moves. Evercore sees Apple TV as the ideal way for it to further monetize its existing customer base. Netflix, don't say you haven't been warned.